The barbell investment strategy for retirement. Here it is, my friends. It's going to be awesome. I cannot tell you how much we have to cover here in a short amount of time. There's not really any reason for it to be short, but it's just because it's on my head and I got to get it out, The interesting thing about doing this YouTube stuff is I've had spreadsheets of all kinds of different ideas for as far back as I can see. I just said, what if I did this? What if I did that? But I had no place to share it with anybody. It's frustrating. So now I get this YouTube channel and it's just as fun for me. It's crazy. And look, I don't have all the answers. I mean, this is just one example. You can do your own spreadsheets and share them with me for sure. But at the end of the day, it's just something that I find was interesting. If I find it interesting, maybe you will too, and you'll get some value out of this, because for me, I do. All right, so the synopsis is we have a barbell approach to retirement. We're saying we're going to take a certain amount of money and put it in cash, and cash is being CDs and stocks. All right, so what we're going to do is we're going to start with $500,000 is what we're going to start with. How much will go into stocks? How much will go into cash? And again, in cash, I'm using CDs, essentially a 10-year treasury yield, because that's roughly what a CD can give us. You know, look, you can make, or a Ginnie Mae fund is kind of where the cash would be, in my opinion. But either way. All right, so we're saying essentially we're going to say we're going to have a 6%. We're going to have 25, 30, and 35 a year. 25, 30, and 35 a year. And this is what's going to happen is this is the amount we need. Oops, I just got to go backwards here. This right here is the amount we need on top of Social Security to pay the bills. All right, so it literally doesn't matter. But for simplicity, we'll say Social Security gives us $25,000 a year, and we need 50. So we're going to have $25,000 coming from our portfolio, which is a 5% yield. Or if we need 55, we're going to have $30,000 coming from our portfolio with a 6% distribution yield. And if we need $60,000, we'll have $35,000 coming from our portfolio, which is a 7% distribution yield. All right, then we're going to do one of two things. We're going to have 5 years or 3 years of cash. So for the next 6 episodes, we're just going to have 5 years of cash. All right, so 5 years of cash. And then what we're going to do is we're going to have it just a straight increasing rate of consumption model, where you're spending $25,000 this year, $25,000 plus inflation the next, and so on and so on. And then we're going to say we're also going to do the same thing, except we're going to reduce our spending by 10% in year 10, at the end of year 10. I hope that makes sense. So, all right, let's dive into this. You'll see what I'm talking about. So this is the first one, a barbell investment approach portfolio for retirement, a 7% distribution yield. So we're taking $35,000 a year from the portfolio. And what we're going to do is we're going to take 5 years of cash. So 5 years of cash is 35,000 times 5. It should be 175. 35 times 5, and it is. So that's 5 years of cash. So let me draw you what this looks like here. All right, so this sometimes it's easier to draw it than just to show the spreadsheet. 175 and 325. 500,000. Boink, boink. Does that make sense? So you got 175,000 in cash, and again, you could look at a Ginnie Mae. It's probably a good way to look at it, and 325 in the S&P 500. All right. So now what you'll see is you have inflation rate in 1963. So we're going from 1963 to 2018. All right, now the problem, well, you're not going to see here because we're going to run out of money. But anyway, 1963 to 2018, we're running these numbers. We have inflation. This is each and every year, the CPI, the average inflation. So I just averaged the inflation for 1963. I averaged it for 1964, and so on and so on. And that's the inflation rate. And then we got to, actually, that's 1.3. We got to make it a percentage so we can easier to calculate. So anyway, this is all inflation stuff right here. All right, so now we're using a 10-year treasury annual yield data. The average yield over the course of that year, 1963, was 4%. So initially you say, wow, the 10-year treasury did much better than inflation rate in 1963. All right, so that's what's happening so far. Now, at the end of the day, why am I using a 10-year treasury? Because it's, in my opinion, the most important interest rate there is out there, for sure. It's reflected in intermediate bonds, but CDs can reflect treasuries as well, 10-year treasury. Like right now, a CD is paying more than a 10-year treasury for sure. And that, well, it's the inverted yield curve, blah, blah, blah. Look, CDs will give you historically, roughly, this similar to a 10-year treasury yield. But, I mean, not all the time. I get that. There's always you get a different approach to take. But if I like the Ginnie Mae is always my starting point, which is VFIIX. What I can get in the Ginnie Mae versus what I can get in a CD, they pretty much correspond. And I'm using that as our yield for the amount of money that we have in the bucket of cash. All right, so using the yield on the 10-year treasury, because essentially what I'd advocate is the first year you have nothing but cash, a savings or checking account. Then you got a 1-year CD, a 2-year CD, a 3-year CD, and a 4-year CD. And I would think on average you should be able to get roughly a 10-year bond yield. Look, you can dispute that. That's fine. I frankly don't care. But at the end of the day, you got 1 year in cash, a 1-year CD, 2-year CD, 3-year CD, and a 4-year CD. Right? I hope that makes sense. And we're averaging the interest that you're getting on all those things. The reason why I don't want to do each and every CD, because man, that's too much work, man. I'm just saying at the end of the day, we're going to historical average yield of a 10-year treasury. You don't like it, that's fine. Yeah, the issue that some people get with, your model's wrong. Man, the model is always wrong. This will not be right going forward. It doesn't matter. The model is always, there is no back testing that you can say, well, back tested well, thus we can freaking hang our hat on it. It just gives you something to think on. If you're going to set it and forget it, this is not, you should never set and forget it when it comes to retirement planning. For heaven's sake, I don't care your stupid back testing. We can back test it to we're blue in the face. Back testing is not synonymous with what will happen in the future. Anyway, but I like using 60s and going to 70s, 80s because we have an era of high inflation. We start with low interest rates and low inflation. Then we have a year of high inflation. Then we have a year of higher interest rates and dropping inflation, which is nice. Then we got a booming market. Then we got a correcting market. But even the market from the late 60s to basically up until 82 basically did not much, hardly at all, relative to the rate of inflation. So it's a wonderful time period to say, if I was able to survive this time, I think I'm going to be in a good place because of the volatility of inflation, the volatility of interest rates, the volatility of the market in the early part of it. From 73 and 74 got hammered. We had a couple down years in the 60s. It's just a wonderful place to start. If you start, like I said before, 1980s, you're just starting with the goose was laying golden eggs and all you're doing is picking them up. All right, so what you can see, we take our $175,000, all right? Now what we're doing is we're going to take this right here, $175,000, we're subtracting out $35,000 because that's the amount of money we need from the cash bucket in the first year. I hope that makes sense. So that leaves us with $140,000, right? Because we have $175,000 to start with, but we need $35,000 at the beginning of the cycle, and we're not getting any interest on that $35,000. Now, we're going to give an average yield of 4% on this. So we're saying we're going to take this 140, we're going to times it by 1.04, and at the end of the time frame, we have $145,000 left. Now, we're going to inflate that $35,000 that we need to spend by the rate of inflation. Here's the inflation rate that we're using right there. 1.3 is the only thing I could pick offline, and I looked at a bunch of different sites, and I had to kind of decipher this. Not that hard, but anyway, you take 1.3, you divide that by 100, and then you add it by 1. It gives you the number you can use to do a simpler mathematical calculation. So, all right, we have 35,000. But we got to times that by whatever the inflation rate was, which in this case is 1.3%. So the following year, we need $35,455. Does that make sense? All right, so now what we do the following year, we say we have $140,000, but we have the $140,000, which is minus this right here. So the following year, we're going to take 140 minus that, which gives us that right there. So we have at the beginning of the following year, and this would be 1964, we have $110,000. Why? Because the beginning of the other year, we had 140, but we had to subtract out the money we needed for that year's of expenditures, which was adjusted for inflation, which left us $110,000. Now, the $110,000 also grew this year, happened to be another 1.3%, and 4.19%, which is the yield on the 10-year, which meant we're left with $114,000. And we just keep doing it. We do it every 5 years, right? So basically, about the end of 5 years, we have essentially hardly anything left in the account. And so now we do it again. And we say, okay, here we're going to take so here what we're doing is we're taking this, the year before, we had $45,000 left in cash, right? Which got 4.93% yield, but we needed $37,549. So we have about $10,000 difference between how much we had left in cash and how much we needed adjusting for inflation. But that if we only put $10,000, it won't be enough for this to live on because we need $38,000 the following year. I hope this all makes sense. I know there's a lot to chomp on, and I'll give you I'll wrap up everything in one final video when we're done here. But so we got 45,000 to start the year. It grew at 4.93%. We needed 37,549 in cash for that year. So we take 45,000 was 47,983. Subtract that amount, but now we're down to not enough to live on, so we got to take it from stock. So this is year 5, and we come over here and we go to the stock market. All right, so now this is 1967 is year 5. All right, so again, the S&P 500, we're starting at 1963. It closed at the closing amount doesn't matter. It just all that matters is the yearly change. And 22.8% in 1963, 16% in 64, 12% in 65 is down 10. So you can see that. So basically, and then was that 69? Yeah, 69. We had a couple good years to start, but we had a couple not so great years towards the end. Either way, higher. Actually, inflation wasn't bad back then. Yeah, no, inflation was pretty low. It was in the 70s when inflation really started kicking in. All right, but at the end of the day, so we start with 325. We're not touching this because we have the cash bucket taking care of our immediate spending needs. 325 grows by 22%, so it grows to 399. I hope that makes sense. So we got D5 right here. It grew by 1.228%, and that gives us $399,000. The following year it grew by another 16%. The following year it grew by another 12%. The following year it followed 10%, so we're now to 470. Now what happens is, how much money do we need to pull from this account in order to live for another 5 years? Well, it's pretty simple. We need 5 years of this amount right here. So the amount of money we need to start year 5, $37,549. We're timesing that by 5 years. All right, so we're saying we need $37,549. We don't know what the inflation rate is going to be, so we're just making a speculation that we'll need more or less than that, depending on the interest that we get on our cash accounts, depending on what inflation is. At the end of the day, we say we need $37,549. We need it for 5 years. So we take $37,549, which is this. We times it by 5 for 5 years, and then we subtract the difference of these two right here, which is 47,000 minus 37,000. So we don't need 10. We have 10,000 that we're bringing over in order to live on. So we need $177,000. I hope that makes sense. And we're going to pull it from the portfolio. So anyway, so we start the year at $470,000. Now what happens is we say, okay, $470,000 grew by 23.49% in whatever year this is, 1967. But we got to pull this amount from that portfolio, $177,000. So we start the year at 470. It grew by roughly 24%. But we need to take a distribution of $177,000 in order to live off that. All right. So now we're at 470. Grew at 23%. We're taking 177,000 out. We're still left with 405. A lot going on, I know. All right, and I'm not going to explain each and every year, but I want you to get a gauge of how this works. All right, so now the same thing happens. We go down, and now we're at year 1972. So let's take a look at inflation in 1972. Still not, it was as high as 5.5 and 5.7. It's getting higher for sure. Now in 1972, we are down to 3.2. And the yields, though, which is interesting, the 10-year yield was higher than inflation by a pretty significant amount the whole time, actually, until 1974. So this is why I wanted to use a strategy, because I find it that if we're not giving an interest rate return that was realistic and inflation that was realistic, and we're just using average numbers, I mean, again, I'm just back testing it, but I find that back testing to leave a lot to be desired, if that makes sense. I like using the real return someone would have got if they would have done this relative to inflation as well. Because what you're going to see here in 1974, our yield is only 7.56, but inflation is at 11. In 1975, our yield is 7.99, but inflation is at 9.1. So now inflation is rearing its ugly head relative to the yields that we're getting, and it's hurting us big time. So what's happening here in the first basic 10 years, our yields are significantly higher than the rate of inflation, which means we're carrying on more after each 5-year cycle. We have more of proceeds that we can bring to the next year. But that will change. I'll tell you, it's going to change. It won't be bad. It's going to be horrific because we're going to run out of money. All right, so now in 1972, all right, we're getting 6.2% on our bonds. All right, so we start the year, we need 46,962 times 5. We need 5 years of 46,962, and this is with real live inflation numbers. And we actually have a deficit of about $2,700. We only had $44,000 left in the cash bucket of the portfolio, but we needed $2,700. We needed $47,000 to spend. So we're going to bring a deficit forward, which means if we did 46,962 times 5, we need roughly $235,000. But because we had a deficit bringing forward, we need an extra $2,000 from the portfolio. Hope that makes sense. All right. So the portfolios, we have $237,000 from which we get it from the stocks. We get it from the S&P 500. The year before the S&P 500, we had $490,000 in it. We had an 18.98% rate of return, which is great. And we saw 490,000 times 18.98% rate of return minus the 237 that we needed to take out to live for those 5 extra years, left us with a portfolio of $345,000. All right, so we're still good. We're still well above after 10 years where we started. We started with $325,000. We're well above that after 10 years, which is freaking awesome. It is. It's fantastic, but it's going to get worse now. All right, so now what happens is we fast forward, we keep living. Again, now you start to see inflation at 6, at 11, at 9, at 6, at 6.5, at 7. Now it's going to start getting dicey. So come 1977, all right, so Carter is now in office. We have 300, okay, so actually at the last part of 1976, we need $665,000 of income to live on at what was the equivalent of $35,000, basically 16 years previous or 15 years previously. So basically our income needs have doubled with the rate of inflation. So we need $65,000 to live on. We times that by 5, which means we need $321,000 in total to come from the investment portfolio, because we are carrying over about $9,000 in deposit, which is good. But still, we need $321,000 from the investment portfolio because inflation is rearing its ugly head. So if we go over the investment portfolio, this is where it starts getting a little bit nerve-wracking. So we're about 15 years into the cycle. We started the year with $368,000, but we took a tumble that year. We had a down year of 7.18%. And this is where, look, from 73 to 74 to 77, the markets they did not, that was a bad 5 years time frame. It really is bad. This is one of the 5-year time frames that does concern me for anybody who's thinking that if you can hold it for the long term, you're going to be okay. There has been 5-year time frames that just wasn't. 2001 and 2 is an example. 73 and 74 was another example too. So in this case, we're hurting. There's no other way around that. Let me pause for just a second. I thought I heard that. Let's go over the ramifications of what happened if you started investing in 1973. If you put $100,000 in your portfolio, you're down 14.66%. Then you're down 26.47%. Then you're up 37%, which I'm telling you, it sounds great, but the losses are painful. Then you're up 23%. Then you're down 7.18%. So you're sitting on $98,000 after those 5 years. But yet, if you look at inflation, let's go over to this. So in 1973, you have a 6.2% inflation. So we take $100,000. Let's just say we needed $35,000 a year times 1.062 times 1.11 times 1.091 times 1.058 times 1.065. That $35,000 now costs almost $51,000 in income. And yet your portfolio, while it didn't get hammered, is still down in the negative. Relative to inflation, before you had $100,000, but you needed $35,000. So before you had $65,000 surplus, if that makes sense. You're up $65,000. You had $100,000, needed $35,000. Now you have $98,000, and you need $50,000. Let me write this down. $98,000, and you need $50,719. That's $48,000 right there. So just the cost of living alone costs you almost $20,000 because the cost of living rose while your inflation, while the stock market didn't do anything. You actually lost a little bit of money. That's tough. All right, so let's keep going back, because what we're going to see here is now that the market was up, we're in year 1976. All right, so we had $368,000. Which lost money, fell to 92%. So lost. So I'll show you what I'm talking about. 368,000 minus 7.18%, which left us with 341,000, and we have to take 321,000 out of that, which is going to leave us with a Spartan $20,000 left. That's it. All right. Now the nice thing is that that money we took out is going to cover us for the next 5 years. So it's fantastic. But what happens is we're going to run out of money here because watch. So we're covered for the next 5 years. I mean, we need 70,000 this year. We need 75,000 next year. We need 84,000. Why is it so bad? Because inflation is, again, 7.5%, 8.5%, 9.5%, 11.5%, 14%, 13%. It's tough, man. So basically, by the year 1982, we've got no money left. What happens is we have $93,000 in our savings accounts, our cash account. It did grow at 13 point, let's see, the yield on that guy is right there. The yield, it did grow at 13.92%. Left us with 93,000, but because inflation that year is 10.3, we needed $105,000. So we had $105,000 minus $93,000 that we had left in savings, and we come over here to our 32,000 bucks, and we ran out of money. All right, we didn't have enough. I mean, we had just enough to cover the year, and now we're broke. We ran out of money in year 20. Now, with that said, we had 20 years of pulling 35,000, the equivalent of 35,000 a year out. Man, that's not so bad in my opinion. I mean, think about it. You retired in 1963. I don't know, you're 60 years old. You have 80 years. You had 20 years of living pretty good money, taking a 7% distribution rate. Obviously that's risky, but you were able to get by for 20 years under some serious chaos in the market. So stay tuned. The next one, we're going to show you what happens when we reduce our portfolio by 10% after 10 years, because again, the idea, and I think it's proven for the most part, is that you spend less as you age. And in fact, you spend significantly less, and I'm going to show you here, and you'll get a lot more out of that. All right, so stay tuned. Thanks.